Bob Burnett brings something rare to Bitcoin mining. Not just years in mining, but decades of high-level experience in technology and business before mining ever existed. That gives him a uniquely mature perspective on where this industry is headed. In this episode, we dive into one of the most important questions in Bitcoin: how decentralized mining really is, and how we can keep it that way. Hello, Bob, and welcome to the HashLabs podcast.
Hi, Jaran. So nice to see you, and thank you for having me.
Nice to see you too. And can you quickly introduce yourself for the listeners, for those who may not know who you are?
Yeah, so I run a company called Barefoot Mining. We've been in the business since 2017, so I guess this is our ninth year. I think most people would probably call us a mid-size miner. Maybe a small to mid-size miner. We focus on off-grid. We do have some on-grid operations, but we do off-grid as well. We do a little bit of hosting, but the majority of what we do is self-mining. And I also write for a financial advisor magazine. I do a monthly article for them that goes to 400,000 wealth advisors in North America. And I'm on the board at Ocean Mining, and I have investments in several, companies kind of across the whole.
Can you tell a little bit about your background and how you got into all of this?
Sure. That's a very kind way of saying you're quite old, which is true, by the way, especially for those who can't see and can only hear. But yeah, my background's in computer science. I spent most of my career in the personal computer industry, really technically starting way back in the late 1970s, but predominantly in the 80s, 90s, and the first decade of this century. I was the chief technical officer at a company called Gateway, which some people, especially in North America, but some parts of Europe, we were quite popular. At one point, we were one of the top 5 personal computer companies in the world, making about 10 million PCs a year. We're a Fortune 200 publicly traded company, too, which gives me a lot of perspective. Maybe we'll talk a little about the public miners today, because I think there's some interesting things happening with them that really are going to have a big impact on the future of mining. And then after doing that, I spent about 25 years in that space. So primarily in product development, designing laptops and servers and PCs, but TVs and cameras and MP3 players and things like that too. And then I started a technology incubator. I did that for about 10 years and then stumbled into our world, as I said, in 2017.
And you have, it seems like you're spending quite a lot of time thinking very deeply about where the industry is going. You have developed some very interesting frameworks, including the trilemma, and also I think the most important framework you have developed is the wild horses. So can you explain that framework for the listeners?
Sure. Well, I try hard to, and I think like good Bitcoiners, I try to have a low time preference, and I try to think not about today and prioritize today, but think about the future. And, part of it's for me, obviously, but I even have 7 grandchildren now. So I think a lot about what's the world they're going to grow up in. In specifics to your question, though, about wild horses, if we look back at 2021, when the China mining ban occurred, it really got me thinking about what situation the ecosystem was in, how healthy was the ecosystem. And one of the things that I saw emerging was there were 3 distinct sizes of miners. There were what I call the elephants, and the elephants were the people trying to build sites 20 megawatts, 50 megawatts, 100 megawatts plus, these large sites. And I saw a very common characteristic of them. I mean, they were big and powerful, but I also saw they take a long time to develop. They're impossible to move, right? Once they're there, they pretty much you can't move them somewhere else. And I realize they're very easy to hunt. And so in a world where knowing Bitcoin is going to be perceived adversarially from a lot of the power and wealth infrastructure of the world, I said, well, If we get too many elephants, we have a problem, because they can be shut down or impaired or taken over very, very quickly. The other end of the spectrum I call the rabbits. And the rabbits are the individual miners that might be anybody running a bid axe or an S19 in their garage, maybe even a small business that throws an extra S19 or S21 or M30 or something like that in a server closet. And the thing about rabbits is rabbits individually are not powerful. But if you have enough rabbits, they can be powerful. And I think a way to look at that is if you're a farmer and let's say you have a field of produce, maybe it's cabbage, and one rabbit gets in the field, it's not a problem. But if you have thousands and thousands of rabbits in your field, you have a problem. And the moment you start as a farmer, you try to shoot one of the rabbits, the other rabbits scatter. Like you can't hunt all the rabbits, and that's part of the power of the rabbits. So what I also realized was that in infrastructure where we don't have a lot of rabbits is very dangerous too, because they are the most adversarially resistant. They're like the guerrilla fighters, right? You can never kill them all. You always have some part of the network that exists, but it's hard to scale. The other common characteristic of rabbits and elephants is they tend to be what I call captive. So one of the most prominent aspects of that is, where do they get their power? So in both cases, it's almost always grid dependent. So there's a third party providing the power, and it requires the permission of somebody else for you to have the power, and also requires the competency of somebody else for you to have the power. So even the big companies that have power purchase agreements and long-term contracts and lots of infrastructure, they're still not immune to these issues. For instance, as I think a lot of people probably know, in Texas, there's a tremendous amount of hash power. And when I talk to some of my mining brethren in Texas, one of the things I'll say to them is, are you really confident that in the long run, you're exclusive? Because almost all of them are exclusively in Texas. Let me say that as well. I said, are you really confident that that's a secure position? Because imagine a world in which instead of Donald Trump as president, we have Elizabeth Warren or AOC, for instance, as president. And imagine we have a Democratic governor. There's a candidate there called Beto O'Rourke, and he received over 40% of the vote in the last election cycle. So if those two things flipped on you, do you really want to have all of your capital deployed, all of your hash power inside one state? Because the world could change quickly. It could be attempts to ban mining. It could be taxes on mining, these other things. The other thing about being captive, this applies more to the elephants, is a lot of the elephants are public companies. And when you're a public company, you're not only captive on the energy side, but you're captive because of who you serve. You serve these shareholders, and it changes your mentality. And we can maybe get into that a little later. But when you operate as a public company, probably the biggest thing, though, is that it puts you in a high time preference position. Like you have to perform every quarter, and the world is looking at your quarterly results, and they don't care too much about 18 months from now. They care about what you're doing today. So when I looked at it, what I realized was that sitting between those two, the rabbits and the elephants, and the captive elephants and the captive rabbits, was horses. What I call horses. A horse is a smaller animal, but it's still powerful. They're very mobile. And so what I set out to do, really, the China mining ban was really my inspiration, both for this concept and the direction of my company, was to start building small to medium size operations that I call horses, reduce my dependency on other people generating power. That's the wild part. So I believe that they hopefully in addition to a reasonable amount of rabbits, an infrastructure that decentralizes mining and provides a lot more adversarial resistance in bad times. And I think that's one of the things too, is I think for the most part right now, especially in the West, especially in North America, I should say, mining is it's not very controversial, but only 2 years ago it was. And 2 or 3 years from now, it could be again. And the thing about the horses, and by the way, I should categorize it. A horse might be a mining operation from a few hundred kilowatts to several megawatts. But the common characteristic is they can be moved very quickly. They usually are small enough that the outside world doesn't know they're there. So unless you announce yourself, nobody really knows you're there, and you can move very quickly. So that's been the focus of my company, to build as many of these kind of sites as possible and encourage others to do the same thing.
So you really have two advantages, I would say, according to your description of the wild horse sites. One is that you yourself, your operation will be much more resilient. So there are some personal benefits in that. And the other is the network benefit, right? So can you go more into detail on the benefit to the Bitcoin network and how it makes it more resilient to have these wild horse sites?
So we have what I consider to be a very unfortunate and not particularly healthy situation in mining today. And the situation is that 1/3 of the hash power of the network is in publicly traded mining companies. If you add in kind of semi-state controlled or large private organizations, we're probably over 50% of the network in that, what we would call elephants, based on what we just went through. Additionally, almost all of those organizations have chosen to use pools for their mining. And I find that, by the way, fascinating. We may want to dig a little deeper into that, but they direct their hash power to Foundry, to Ant Pool, to F2 Pool, to via PTC. And so what has happened is we have a greater than 50% hash power concentration in the elephants. And then we have, in the mining pool side, it's probably approaching 92% or something like that in just a handful of pools. And this is very unhealthy because it doesn't create a situation where I think the Bitcoin network is as censorship resistant and permissionless as I think we all want it to be. Kind of is inviting, again, if we go to an adversarial situation, it's much easier to impair it if we want to shut it down. And there are some nightmare scenarios. There's an article I wrote a few years ago, it's called Satoshi's Heel, that talks about what happens if we get too many elephants and the network kind of gets impaired very quickly. But the second can be just state control over template creation. So the majority of the blocks produced today by the network come from a very small number of distinct templates. And for those not as familiar, what happens is, as a block is produced, the miner, and by the way, a miner in my definition is a organization that runs a node, that manages a mempool, that creates block templates, which means it selects the transactions that go in the block. It has the ability to signal for protocol changes, and it controls hash rate. So by that definition, most of the companies you probably think of as miners are not actually miners. They are what I call just hashers. Doesn't mean they're not valuable. It doesn't mean they're not doing something of significant, but they're really not even part of the network. They have abdicated or given control of the mining responsibilities to the pool. The exceptions would be anyone self-mining. And for instance, Marathon, which I have some issues with Marathon, but I always am respectful of the fact that they largely self-mine. So they're exercising their right with, I don't know, something on the order of 3 to 5% of global hash rate. People on Ocean using datum would largely fit the definition of a miner. Those people that maybe are using SV2 with demand pool would fit that profile. But we have very, very few of those, right? So when we look at the Marathon, the Ocean, the demand pool, and maybe a few other small solo mining things, we're talking about well under 10% of the hash rate. And that means that the ability for those large pools to direct the network is very strong. And you and I were beforehand just talking a little about BIP 110. Well, as time goes by, there's going to be several protocol changes and things that the community has to consider. Things like quantum resistance. There's a time issue that has to be fixed with Bitcoin. There's obviously this BIP 110 proposal, which has a lot to do with spam control and things like that. Well, we're at a point where a very small number of organizations have the signaling capability, because those protocol changes are typically signaled through the miners. So the miners usually have a signaling threshold, like in the case of BIP 110, it's 55% of the blocks in one epoch, in one difficulty adjustment period, signal in favor of it for it to activate. And back in SegWit, it was like 95%, 90 or 95%. By the way, the reason BIP 110 is at 55% is, which is a lower threshold, and some criticism has come of it, is that if it was a higher number, like back where the SegWit number was, just one pool, one of the top 5 pools deciding not to participate would essentially give them veto power. They could just decide kind of for the whole network, and it wouldn't activate. So this centralization of template creation and control over the hash power, like even in the present day, is having some negative impacts, and it has real danger of, let's say the world governments want to cooperate and they try to force OFAC compliance or create blacklists of addresses that they don't want blocks to be produced with those addresses. It makes the job much easier. But if we have hundreds of horses and thousands of rabbits all creating their own templates, even with 30 or 40% of the hash rate, which is probably about where we are today, it would make us very, very resistant to those sort of attacks. But we don't. Even the horses and the rabbits largely use one of the big pools.
So how would such an attack, like let's say a 51% attack, or like a government attack where they mandate miners to use certain pools to enforce OFAC compliance, for example, how could that play out in practice?
Yeah, I mean, it would be tricky, but let's just start. Let's say the Western powers decide to we'll do an extreme example. Somehow the Western powers and China cooperate. Okay, and so they're going to go knock on 2 doors. First of all, they'll knock on Foundry and Antpool and say, hey, which is about 67% of the template creation, and say, if you guys don't start producing templates with adherence to this blacklist or that are OFAC compliant, we're shutting you down. So that would be the first step. The second step, very almost in parallel, would then be to go to Bitmain, to Riot, CleanSpark, Marathon, etc., and say, if you move your hash rate from those pools and try to restrict the hash rate directed at them, then we are going to shut you down. And the third step in the process would then be to go to Binance and Coinbase and the exchanges and say, if a chain split occurs and a non-OFAC compliant version of Bitcoin emerges, you can't list it. So Would it work? Maybe, maybe not, but it would be massively disrupted. I think what they would, they would control the template creation, then they'd go after the hashing community, and then they would go after the on-ramps and off-ramps. So now if we flipped it though, if we had a world where maybe we had much greater pool diversity and much greater template creation diversity, and no pool had more than 15 or 20%. A lot of them were using Datum or SV2 to allow the individual miners to create the templates. Now it gets a lot harder for them to do that. And if there's a lot of rabbits and horses too, they won't even know who those organizations are and where they're located and how to go after them. So that would be a short version of how we become so much more resistant to those kinds of censorship attempts.
So essentially, the incentive for governments to go after these pools becomes much smaller if there are a lot of wild horses and rabbits, just because their cost of doing that sort of attack would be very high. Yeah, very interesting.
Yeah.
So, we talked about the network benefit of increasing decentralization. How do you think the network will evolve over time in practice, and how do you think we can make an impact to that?
Well, here's what I think is going to happen, but it's also what I hope is going to happen. And I have to be very transparent and honest that I have to make sure I'm trying my best to not let my hopes and desires taint what I predict. But I want to be honest with people that's the case. So one is, I believe the public mining companies have been a net negative to the Bitcoin community. Part of the reason is what we just talked about. But another reason is that I believe they have grown unnaturally fast, that they were not motivated to create profitable, efficient operations. They learned that the market rewarded growth over profit. And so they kept growing even when they shouldn't. And so part of the reason, some people might say, well, isn't it wonderful we have a zettahash of hash power in the network? And look how secure Bitcoin is, and look at all the capital that can be. So, well, there's a grain of truth to that. But by my estimation, the network should be more like 700 or 750 exahashes, 20 to 30% less than it is today. And that this unnatural growth was largely the result of these public companies overgrowing. If you look at their financial performance, you'll see they're miserable. They've done very, very poorly. Now, what has happened, though, is they were finding it already over about 2 years ago, starting to find it increasingly difficult to find bigger and bigger patches of on-grid energy. Because to them, finding 10 megawatts at 3.5 cents per kilowatt hour, right, for instance, is not interesting. Even if it was free, it's barely interesting to them because it just doesn't change the scale of their operation, and it's almost a nuisance to have a site that's small for them. But so finding these big patches at the right price were becoming increasingly difficult. In parallel, we started to see the emergence of AI, and there's a great overlap in the power that the large pubcos have access to and the power that the AI community, and I guess even in general, the data center community desires. So we've seen a pivot, and the pivot has been CleanSpark and Marathon and Iron, and a lot of these big miners have shifted. Some of them to the point of saying they're getting out of Bitcoin mining, some saying they're not going to add any additional capacity to mining. And so we've seen flat global hash rate since about September now. So we're almost at, what would that be? 6 months of no hash rate expansion. And I think that that's what's going to continue. What I think is happening in parallel, though, is like I can speak for myself, and I'm public with some of this stuff. We have learned to produce power by ourselves. So, like my company, while we still call ourselves a Bitcoin mining company, to a great degree, you could almost say we're an energy producer too. So we have our own hydroelectric facility, we have an anaerobic digestion facility, we have several natural gas wells that we mine directly from the natural gas well. And I should point out, without being specific about any one site, but our cost of energy at those sites is typically between 2 and 3 cents per kilowatt hour. So not only have we learned that we got all of the benefits of independence and autonomy and resistance, but we've learned that we can actually produce power cheaper than we can buy it from others. And if you think about it, it starts making sense too, that we don't have transmission costs. We don't pay taxes. We don't have markup. We don't have, parties between the energy source and us. We own all those things. And so it allows the basic cost. Now we have the problems of an energy producer, right? If a generator blows up or a radiator fails or a turbine doesn't work right, or, we have all those things. And, and by the way, that's built into the cost. The cost of maintenance and upkeep is in the 2.3 cents. But when we're down, we're down. So, we go from having full operation to no operation at that site, or at least in that everything attached to that generator very quickly. And so there's a cost of that. But we think at the very low end of what energy production is. And the only way to do better, honestly, is to do multi-use cases, which I know you have some involvement in, Jaran, where you can, where the energy, where the heat, that basically the heat reuse cases primarily, right? So then the economics can change differently. But I think what's going to happen is the bigger guys are naturally falling. And that's really good. Their assets are being purchased by the AI people. Either the heat reuse cases or the wild miners are lower cost producers. So we still have incentive to grow, and they have incentive to shrink. In terms of hash rate, I think we have good natural forces rebalancing the ecosystem in a very healthy manner. I do still worry about the pools, though. The pools bother me. I mentioned I'm part of Ocean. Again, I have a bias. We range between like 1.3 and 2% of global hash rate. Like the man pool, which also is a newer pool trying to help people with template creation, hasn't got much traction yet. I don't know what their number is, but it's certainly well under 1%. So we still have almost everybody signing up for Foundry, signing up for Antpool, signing up for one of the Antpool proxies. Have you ever talked about the Antpool proxies? I don't want to repeat stuff.
We haven't talked about that in the podcast, but it would be very interesting, I think, for people to know that.
Okay. Well, this is an interesting deep dive into payout methods. I think is really what it starts with. Okay, so what Ocean does, and if you go old school mining, we used to use a payout method called PPLNS. Okay, so pay per last number of shares, last number of last shares, right? So it basically says you only get paid when the pool wins a block, and you get paid based on how much of the hash rate you contributed to that pool prior to that block being won. Foundry really revolutionized things. Was it 2020 or 2021 when they came out with something called FPPS, full pay per share? And the idea was that the pool would take the risk of when the pool would win blocks, and it would just pay the miner every time a block was won. The miner would get paid, whether the pool won the block or not. And so it was highly attractive, still is highly attractive to a lot of companies, because if you contribute a certain input of hash rate, you can predict within a pretty small threshold exactly how much you're going to get. The pool, the FPPS pool, like Foundry, like Antpool, is taking this risk. Now, anybody taking risk only does so in return for some reward, though, right? So they're taking a bigger cut beyond the pool fee that keeps them profitable. And partly they have to, because they have to have a massive reserve of Bitcoin available for periods of bad luck. And there were some smaller FPPS pools. For instance, one was called Titan Pool that went bankrupt because they were a smaller FPPS pool. They went through a period of bad luck. They didn't have enough Bitcoin to pay the people who were hashing with them. They ran out of Bitcoin before they won a block, essentially. So what happened was that as FPPS became very appealing, a lot of smaller pools were losing business to the FPPS pools, but they didn't have enough money to back an FPPS pool themselves. What they did was essentially created agreements primarily with Antpool, who was willing to finance them. And so essentially they became a marketing organization for Antpool. So you could sign up with Antpool directly, or you could sign up with, I don't want to name them, and I'm not being critical of them, by the way. I'm just stating the facts. But part of what Antpool wanted to do was Antpool wanted to control the template. So the companies that were financially backed by Antpool had to use a template created by Antpool. And so when you get into some of the deep heuristics of what work is being done by different pools, what you'll find is there are 8 or 9 pools, all with distinct names and customer bases, all mining exactly the same template, the Antpool template. And so when I say a proxy, that's what I mean. So Pool X has its own brand and maybe been in business for a long, long time, couldn't afford to actually give FPPS to its customers, but didn't want to lose the business. So they signed a deal with Antpool to use Antpool's templates, to have Antpool's financial backing, and they're able to offer FPPS. What I think is interesting about FPPS, though, is, in my opinion, it's going to struggle at some point. And the reason it will struggle at some point is right now, this is what happens the way FPPS decides how much to pay its miner. So if you're a miner and you're connected to an FPPS pool, when a block is won, based on how much work you did within that block, it's going to decide how much money to pay you based on what's called your shares. So you're constantly telling it the work that you've done, and it's called a share. Well, what they do is they say, well, we're going to take the look at the last 144 blocks. We're going to throw out the 3 lowest paying blocks and the 3 highest paying blocks. We will average the remaining ones. And so we will pay you based on that average. Now, on the surface, that sounds good. However, the danger in it is that there's an assumption that throwing out the 3 highs and the 3 lows essentially negate each other. But it doesn't always work that way, because there's a much greater tendency for the 3 high ones to be further from the mean than the 3 low ones. So when you throw them out, that's a little bit of a win for the pool. And that's the insurance I talked about. So the premium you're paying in an FPPS pool beyond whatever the pool fee is this premium that the pool gets. Right now, though, the variance, but even all that said, the variance between the best block and the worst block in a 144 block period is still not tremendous. However, let's just look 10 years in the future. It'll be easier to see then where we're going. If you look 10 years into the future, we'll have been through 3 halvings. So we'll go from 3.125 to, was it 1.56 to 1.78 to 3.7. So we'll be at like 3.7 Bitcoin per block as the subsidy 10 years from today. Interestingly, the historical norm of fees for block is 0.335, almost identical. So if historical norms continue, then 10 years from today, 50% of the block reward will be the subsidy and 50% will be fees. Now, at that point, though, the fees, the variance between the fees will probably get wider, and the pool won't know which blocks it's going to win. So the risk of the pool becomes not only how many blocks did it win, but which blocks did it win? Did it win the blocks with the high fees, or did it win the blocks with the low fees? So it adds a second layer of risk for the FPPS folks. Now, potentially they could change the formula or something in the way the share is, but we've done studies at Ocean. In fact, I did them myself, where for 2 years I ran a study looking at the payout I got from Ocean versus the payout I got from FPPS pools. I had identical machines and identical containers, so I had connected to the same network, in other words, the same latency, the same firmware, the same system, the same everything. And I saw over the 2-year period, it was almost a double-digit number. It was like 8 to 10% difference between Ocean and the others. And it was more commonly 1, 3, 4%. But it was a material difference in my output, my actual payout. So I'm not considering luck, I'm not considering anything, but in my opinion, when you look at long windows of time, when you look at a 2-year period, a 6-month period, a 1-year period, if there are luck variances, then maybe there's an issue with the pool. Like if your pool has bad luck over 2 years, then maybe you're doing something wrong. Like that, is causing you to be slow on your block transitions or those sort of things.
So essentially, if we go a little bit back in the conversation, you mentioned the physical aspect of the mining sites, that you're not really worried about that this centralization in the long term, because you think it will kind of rebalance itself and be more wild horse sites. And I
And
fully
rabbits, I
agree
hope,
with
too.
you. I
And
fully
rabbits, too.
get your point, and I agree with you, because as you said, these sites are more competitive, and it seems almost impossible to get like 200 megawatts, 300 megawatts of like sub 3 cents electricity today. Then you will have to go to some African countries or Southeast Asian countries, where in fact the government or some other very powerful people would be the actual controllers of that land and that site. So then
Yes.
it's not really your site anyways. So
Yes. Yeah.
I think I agree with you there that these wild horse sites are naturally the leaders of mining. And then what you talked about after with the pool layer, which is more difficult. But it seems like that can also solve itself due to these incentives of miners to choose this PPLNS pools over time. Or did I get your point right?
Well, I hope so. So there's a trade-off, right? So I think one thing I learned in conversations with some of the elephants, like what's interesting about the elephants, and I'm talking specifically to the public miners, is I was shocked in discussing with them their intolerance for revenue variance. So again, it comes to expectations, right? Their belief that they have to produce exactly what their shareholders expect is so strong, and they just don't want to take any risk. So if they saw a potential variance of more than 3% in their payout, that was scarier to them than in the long run making more money, which to me is ridiculous. But that's why I mentioned this before. I'm kind of glad we came back to it. Why is it that Marathon is the only miner, and I call them a miner, they are the only miner in the public space that self-mines? Why would Riot and CleanSpark? They have tens of exahashes, right? So they have enough, they would win by themselves on average a block or two a day, maybe more. So what service is the pool? Why do they need others to do that? And why would they pay a fee? Now, granted, they pay a small fee, and it probably may or may not be shocking to those who are smaller miners to find out that they pay like really small fees. I'm not giving away any specifics of any one company, but they'll pay fees like 1/4 of 1% or 1/3 of 1%. Maybe half of 1% would be the upper threshold of what those kind of companies pay. And I know the plebs who are doing smaller stuff are paying 1 or 2 or percent. And so they do have a small fee, but they also have this FPPS premium that I talked about. That's another percent or two, at least, for them. So why would they do that? And it's just that I think for them, the possibility of getting on a shareholder call and saying, we missed our revenue number this month by 6% because we had very bad luck. That is terrifying to them. Even though, by the way, the opposite is just as likely to happen, that they outperformed by 6%. But even at that, their potential variance at their size is very small. But they're so risk averse. They're very short term oriented. They're very fiat Wall Street oriented. I'm generalizing. I'm not saying every person in every organization, but that's the mentality. And I get it, by the way. I was part of taking a company public. We were a Fortune 200 company. We were obsessive about and this is my personal computer days, right? We were obsessive about where was our number going to end up? Where was our revenue number? What was our net number? We were trying to manage those expectations for the shareholders. And our real goal, it's a twisted world where the share price is in many ways more important than whether you make money or not. And I mean, that's just so un-Bitcoiny to me, like, as well. And what you do in the short term is probably more important than what you do in the long term, in part because the executives there typically aren't thinking about themselves even being there 10 years from now. They have a set of stock options. They're highly compensated people. So getting out in 2 years or 3 years or 5 years, that would probably be the longest term optics that they would even be capable of. But even at that, they tend to really just be 90-day oriented.
So if the wild horses are the most profitable miners in the long term and the most resilient, and also all the public miners are transitioning to AI right now, then I assume that there will be less pressure on a big part of the network to actually use these FPPS pools, right? And more that will lead to increased adoption of the new players like Ocean and Demand and PPLNS, right?
Yes. Yeah. I think that was the question you asked me before. I sorry I didn't answer it, but yes, that's exactly correct. And maybe we'll even see some of the pools who are prominent that I respect, who went to FPPS, come back. I mean, that they may find that that's okay. Because, by the way, as a pool operator, FPPS is very efficient because there is as you scale, you have to have a fair amount of infrastructure to manage what we call basically the share area of the pool. So if Jaran, you have a certain amount of hash rate and shares, and I have mine, and it has to keep track of that and be fair about it and make sure everything's going well. But that's the main job of the pool. And because the job of the pool is to divide the pie up, to divide the Bitcoin up when the block gets won. That's really the job of the pool. And so as soon as you have FPPS, as I mentioned before, you have this whole other thing that becomes much more difficult. It also, by the way, the nice thing about PPLNS and the way, for instance, in Ocean works, because Ocean pays the miner directly from the Coinbase, and certainly others can do the same thing, but it's a non-KYC form of payment, which to the smaller miner, whether it's a rabbit or a small horse, can often be very desirable too.
Yeah, absolutely. So a lot of benefits to transitioning to these pools. And, to me, I'm convinced now. I think also that Bitcoin will remain decentralized and increasingly become decentralized, both on the physical mining side or hashing side and also on the on the mining side with the mining pools. So yeah, nothing to really worry about, actually. Do you have any closing thoughts before we finish?
Well, this period that we're in right now is testing people. And what it should do, and I think it is doing, is it will separate the strong miners from the weak miners. And I think it's important to remember that this is a commodity production business. It requires operational excellence. So if you're a miner or you're thinking about getting into mining, you need a lean, mean organization that's focused on doing your job with the lowest possible cost structure. It's not the kind of thing, even if you decided you want to be a public company, it's not a path to multi-million dollar a year salaries and corporate jets. It's renting a Toyota and sleeping in the Motel 8, not the Ritz-Carlton. I think it's also important to note that block space itself is our product, which I think people miss a lot. And this is probably a whole different episode if you ever want me back. But what I think most people would say is, if you ask them, what does a Bitcoin miner do or what does it produce, you would probably get the answer, well, they produce Bitcoin. I think the appropriate way to look at it is miners produce block space. They get paid in Bitcoin, but what they produce is block space. And so if you take that mentality that it is your job as a miner to produce block space, then you should realize quickly that you need to be the one creating the template, because that's where the block space is. So, again, there's nothing wrong with people using an FPPS pool, I guess, but you are a hasher and you're not in control of very much at that point. So, I would encourage people, if this is an interesting area to you, to move toward one of these directions: solo mining to ocean to demand, something like that, where you start taking control of the actual thing that you are responsible for producing, and that's block space.
Thank you very much, Bob. This was a very interesting conversation.
Well, thank you, Jaran. It's always great to see you.
And where can people find you?
I'm pretty active on Twitter. I go as a boomer_BTC there. I have a show called The Bitcoin Boomers with Larry Lepard and Gary Leland that people can see on YouTube, Apple, Spotify, etc. And my company, Barefoot Mining, is at barefootmining.com.
Thank you, Bob.